and it just stays with it.
All the technicalities of putting on a show.
Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Craig Martin. Craig is a certified financial planner, and he's a principal in the Family Wealth Consulting Group. And that group is a fee-only financial planning company. Craig has been providing asset management services for over 35 years,
Whoa.
and he's the author of Asset Class Investing, and I'll bet if you asked him, he would be glad to send you a copy. Today, Craig and I are going to be talking about alternative investments.
Whoa.
So this is sort of a relatively new area, expanding area of investment. And Craig's been active in this area, so I asked him to come and share some of his wisdom about this today. Craig, thanks for joining us as a guest today.
Absolutely, Mike. You know, these shows are recording some of the best financial, legal, tax people in our community in the Bay Area here. There just isn't anybody else doing what you're doing. So I commend you for that, and I'm proud to be a part of it.
Well, thank you, Craig. Glad to have you as a guest.
Glad to be here.
Okay. Well, Craig, this buzz that's going on maybe a little bit. You know,
Yeah,
people are thinking. Well, one, of course, they're afraid to go on the stock market. They're thinking about alternative investments. Maybe you could tell us, you know, what are alternative investments, and why should people even think about them?
Alternative investments are, the way we define them at the Family Wealth Consulting Group, is that they are anything but stocks or bonds.
And maybe you can say conventional savings accounts. I mean, those would not be alternative.
Yes, that's true.
Yeah.
So what we've got a fund we use to invest our clients' monies into alternative investments, and those alternatives currently include managed futures, options, real estate, direct investments in real estate. We're looking at agriculture, timber, oil and gas, pipeline, anything but stocks or bonds, and not marketable securities. So you can buy managed futures in a mutual fund, but we are not doing that. We're doing it direct into the commodity trade advisors, CTAs. We're buying real estate directly. We're buying direct into oil and gas and agriculture projects.
Okay. So why are these alternatives becoming more popular now?
Because people are scared of the stock market. Yeah. And people have been investing in these things since the beginning of time. It's just that if you went to the financial planning community or the Wall Street brokerage community, traditionally the only thing they invested in was stocks and bonds and CDs and savings accounts. It is now recognized. There was a Nobel Prize issued in 1990 on how to build a risk-managed portfolio. Surprise, it works. In other words, we're able to build a risk-managed portfolio that gets the returns of the stock market but does it with less risk than the stock market, risk or measurement of volatility. So the opportunity is for us to build risk-managed portfolios using alternative asset classes.
Okay, so sort of add it to the mix.
Add it to the mix, and the more alternatives you add to your stock portfolio, the lower the volatility of returns. So a single stock has huge volatility. The price goes up and down. We measure that as standard deviation. So a number for that would mean that the individual stock goes up 35, 40%, goes down 35 or 40%, but it averages a single return. If we put a whole bunch of stocks into a mutual fund, that volatility gets narrower. And the reason is because we've got a volume, a whole bunch of stocks in there, and each of those stocks has a slightly different range of returns to it or dissimilar price movement. And because of that dissimilar price movement, the total portfolio has less volatility.
So when we say dissimilar price movement, basically what we're saying is when one stock is going up, another stock may be going down, and vice versa. So
that could happen,
yeah.
but what we see mostly is that one stock goes up this amount, the other stock goes up less or more.
Okay.
Positive correlation in the stock market is common. Positive meaning prices go up, everything goes up, prices go down, everything goes down.
Yeah.
In contrast to alternatives where real estate, for instance, has a different price movement than stocks. By definition, it's not a stock, therefore it has different price movement or dissimilar price movement.
Okay.
We find that in most, if not all, of the acceptable alternatives that we're looking to invest into. So in 2008, our core risk managed stock portfolio went down about 35%. Stock market went down 57%. So our risk managed portfolio is risk managed. It went down less than the stock market, but jeepers, it's 37% is a long way down.
Yeah.
In contrast to the managed futures portfolio that we manage, went up 18% in the same time frame. So if you had 50% of your money in the stock market and 50% of your money in managed futures, stock market had gone down 30+%, managed futures went up 18%. The average return on your portfolio is significantly reduced. And that's what we're trying to do. The goal is to mix dissimilar price movement and maintain that market return. So we don't want to reduce the return in your portfolio. We want to maintain market returns or better.
Okay. You know, Craig, when we were talking about these alternatives, I just can't help thinking back to around 1986. Back at that time, what was really hot, just before the new tax law was passed back in Reagan's time, was tax shelters, right? So so those were sort of like these. Maybe you'd like to comment about that for just a second, and how this is different from what those
I suffered
were.
that.
Darn.
And we did suffer that. Yes, I was selling commissionable securities back then and receiving a commission. And yes, it was easy to sell a tax shelter. For every dollar you put in it, you could get $1 of shelter. The mistake we made was that we didn't save that dollar of taxes that were unpaid. We didn't put it into a separate investment. My clients spent it on beer and standard of living and trips and cars because in a few years the tax law changed and all of those tax shelters went to zero in value, and we had to recapture. I'm talking to a tax preparer here, a tax specialist, and we had to recapture all that as ordinary income. And we didn't have any money to pay the tax. It was horrible, just horrible. In fact, it was that event which caused me to give up my license to sell commissionable securities at the end of 1989. And in 1990, I became a fee-only financial planner, which means I no longer can receive a commission for the sale of a security, and I work for my clients rather than for the large corporation or the products that I sell. It allows me to give independent advice and counsel to my clients, and it's much better for me, and the results are much better. We've done great since then.
Good. Well, why don't you tell us a little bit more about this idea of managing risk of the total portfolio and how you build a risk-managed portfolio?
Yeah, it is a very complex subject. I've been using just a lot of words here, so let me go through a series of slides in an effort that we have created.
Were we going to do that? I thought we were going to do that a little later.
Next, okay. So we'll come up to those slides. Building a risk-managed portfolio means that we're going to mix dissimilar price movement asset classes. So inside one portfolio, we're going to put stocks, maybe bonds, maybe cash, maybe real estate, maybe managed futures. The total portfolio is going to, the more we get that diversification in asset class, including alternative asset classes, the lower the volatility we'll get in the total portfolio.
Okay.
The goal is to keep the returns, though, at or above market level.
So, and the idea then also is because of the dissimilar price movements, then that's what's actually helping you to manage the risk by reducing the variation, if you will,
Yes.
from market. Okay.
Yeah. So the easy way to manage risk is to go to all cash.
Yeah.
I mean, there's no volatility to
Yeah,
cash.
right.
Problem is, the longer you hold stocks, the longer you hold cash or bonds or treasury bills, the closer you come to losing buying power after inflation and taxes and costs of doing business. So it is a guaranteed loss of buying power the longer you hold cash or bills or bonds. In contrast to the equity market, where over your lifetime, stock market has produced about 10%. The way you got that was to buy every stock in that stock market. We would expect the stock market to produce that going forward, and the way you can earn that is to buy every stock in the stock market. Problem is, the volatility of that stock market is like this. It goes up or down 18%, but averages about 10%. So it means you've got equal chance to earn 10 plus 18%, which is 28%, as you do 10 minus 18, which is minus 8%. You have equal chance in a stock portfolio to earn plus 28 as you do minus 8, but you're going to average about 10. So the way we reduce that volatility is to add something to it besides stocks. How about real estate? How about managed futures? The classic is bonds or cash. And at the Family Wealth Consulting Group, we're minimizing the cash and bond position in our clients' portfolios.
Okay. So maybe we should get into these slides
boy.
that we were talking about. Yeah. So the frame that we had is explaining the efficiency for investments, how the efficiency of the other investment alternatives compare to efficiency for the stock market. But basically, I think we want to, in the process, sort of illustrate this whole process.
Yeah, if we could have slide number 1 come up. The goal here at the Family Wealth Consulting Group was to help our clients understand the connection between risk and return and what the advantage of having lower volatility is in your portfolio. So we'll get to that in a little bit. First of all, to demonstrate risk and return, the number one, the slide that you're looking at right now has return on the vertical line, increasing returns going up the line, and on the horizontal line, risk. Earlier I mentioned risk is volatility of returns. So the higher the volatility of the returns, the farther to the right it's plotted on this XY axis.
Okay.
So if I plot the S&P 500, it turns out that the S&P has built an index of the 500 largest stocks in America. And it pretty much represents what the stock market's doing in America over time. It has an average return I spoke about earlier of 10%. So the longer you hold the S&P 500, what that says is that the longer you hold the S&P 500, the closer you're going to come to earning real close to 10%, but you're going to suffer 18% volatility during that time frame. So we plotted on the horizontal line at the 18% mark. You see that in red print on the chart?
Well, it's going to be hard for people to tell even the colors maybe when they're seeing this, but anyway.
Okay.
But the idea is on the bottom, if you look at the far right, the S&P 500 shows an 18% return, and next to it you've got what you call the Mod 50. Maybe you can explain a little bit about what that is.
Sure.
And then that has also a 10% return, but it has only a 15% volatility.
So we are experts at building risk-managed portfolios at the Family Wealth Consulting Group. We've built a portfolio that is 70% stocks and 30% bonds. Classic traditional risk management of the portfolio. And that 70-30 allocation produces the same returns as the stock market, 10%, with less volatility, about 15% instead of 18%. Okay? Slide number 2 is what we've added to this chart to help clients understand risk and return. On this chart, on the far left in gold or yellow, hopefully it comes through on your TV screen, is we've plotted a CD, certificate of deposit you could get at a bank. This is an example. It pretends that I could find a CD that pays 10% for the rest of your life.
Mm-hmm.
What a thought.
Yeah, so we say it's an example, but it's not a real example because there is no such CD that exists.
There is no such CD exists. Thank you for correcting that. And because it has no volatility of principal, every year it earns 10%. Mm-hmm. We've plotted it on the vertical axis at the 10% return mark. So in an analysis of risk and reward, what we see is that the stock market has a risk of about 18% volatility with 10% return. A professionally built risk-managed portfolio has the same return with less risk. But as an example that we could recognize, the CD, if we could find such a thing that paid 10%, would have no volatility of returns.
Right.
Okay. So what's the advantage? Slide 3 shows that if we look at over the longest period of time, how much money can I spend out of the 10% that's earned in the S&P 500? This chart shows that there's a lot of independent research showing that we can only spend 4% of our principal. If we had $100,000 in the S&P 500 and bought and held the market, we could only spend 4% of it every year. If we spent 5%, the volatility in the marketplace would be so great that during the down years, we'd spend so much principal, we wouldn't be able to recover if we paid out more than 4%. Mm-hmm. So for every $100,000 in your retirement portfolio, you can plan to spend 4% if you buy nothing but the S&P. If you buy the if you invest in our risk-managed portfolio that we produce at the Family Wealth Consulting Group, then it's got less volatility. That is a primary reason why you're able to spend more income. In fact, we're able to show over the past 44 years that you could spend 50% more. In other words, not 4%, but 6% of your retirement portfolio. So now for every $100,000 in your retirement portfolio, you're able to spend $6,000 a year.
Mm-hmm. And then if you had the CD, of course, then you wouldn't be worried about volatility.
Yeah,
and so you could spend the 10% or maybe
look
a little
at slide number 4, and that's Mike's explanation here. So on slide number 4, what we see is that the CD earns 10% every year, no volatility.
Right.
Therefore, you would feel safe spending 10% of that every year because you know that you could not outlive your principal.
Right. So let's just recap this a little bit. First of all, remember that no such CD exists. I mean, you might find 3% or less as far as what a bank may actually be willing to pay you for a CD in today's marketplace. And then there's the issue of keeping up with inflation. But second, though, that it's very significant that by getting this risk-managed portfolio that you can actually get, if you will, 50% more that you can draw out of the fund with exactly the same market rate of return. Yes. For the two portfolios. Okay.
Go on to slide number 5, and it summarizes what Mike just said maybe. And what it says is that while all 3 portfolios in my example here earn 10%, as we reduce the risk, we can increase the payout. Mm-hmm. What's the benefit of having reduced volatility in your portfolio? Well, besides peace of mind, you get more income during your retirement years. How do we increase the payout of your portfolio during retirement years? We reduce the risk, which increases the payout. Significant amount, by the way.
Yes.
Okay? So the last slide number 6, kind of summarizes what we've been talking about. Topic of our conversation today is alternatives. And because they are alternatives, they are not stocks or bonds, therefore they have dissimilar price movement. And the more alternatives I add to this risk-managed portfolio called the Mod 50, the more it will reduce the volatility of the total portfolio. Mm-hmm. As the risk goes down, the potential payout goes up. dramatically.
Mm-hmm.
Okay?
Mm-hmm.
If I could build a portfolio, if I could build a portfolio with market returns, 10% per year, with zero risk, we could spend 10% a year.
Mm-hmm.
And be comfortable we wouldn't outlive our money.
Mm-hmm.
That's not possible yet. We don't
Right.
know how to do that.
Right.
So as a professional, what we're doing with our retirement clients is helping them reduce the risk of their total portfolio and spending an increasing amount of their total portfolio, because we know that with that reduced risk portfolio, we can get more spendable income.
So it's a sustainable, this is that nice word again, sustainable cash flow. So again, the big concern is by drawing on our retirement fund, and especially with longer and longer life expectancies and concerns about inflation and so forth, that we need to be able to draw on those funds and not run out of money. And if it's not done right, you definitely will run out of money.
It's a serious issue.
Yeah.
Calculating your number, the percentage that can be paid out of your portfolio, takes a professional, somebody who understands how to build risk-managed portfolios, somebody that can look at a portfolio and calculate its risk-reward ratio in an attempt to be able to tell the retiree how much can you spend out of this and be comfortable knowing you won't outlive your money.
Right. Okay, well, let's move on because time is going. Maybe you can talk a little bit about, there's a public real estate market and a private real estate market. What's the difference and advantages and disadvantages of each?
Yeah, good. So what I talked about was using alternatives in a to build a risk-managed portfolios. Alternatives are anything but stocks or bonds. Earlier I described that as managed futures, options, real estate. And what I said is that we're not using any marketable securities like mutual funds or real estate investment trusts. Those I would call publicly traded investments in real estate. The problem is that they're traded on the stock market like IBM or Intel stock are. Uh-huh. So earlier I said that most stocks have positive correlation. Mm-hmm. They don't have negative correlation. So with positive correlation, when the markets go up, everything rises with it. When the markets go down, everything falls with it. And that's what happens with publicly traded real estate in real estate investment trusts, REITs, or mutual funds.
So they sort of follow what's going on in the stock market.
They follow the stock market, particularly in periods of excessive returns. So markets pop up 30, 40%, everything goes up very similar. Regretfully, markets fall 30, 40%, everything does similar returns. Earlier I spoke about our managed futures, which are not publicly traded. We're using direct investments in commodity trade advisors. And those our managed futures in 2008 went up 18% when our average client portfolio in stocks went down over 35%. So that kind of dissimilar price movement is what builds effective risk-managed portfolios. So while we can buy real estate, when we can buy real estate directly, it's an effective risk management tool. When we use publicly traded securities representing an investment in real estate, it's not nearly as effective.
Okay. So there are a lot of people, say like my parents, okay, they bought their home in Silicon Valley, I'm trying to remember, probably about $30,000, which was a lot of money back then.
That was a lot of money back then.
Yeah, back in 1958 or so. Now that home is worth something over $1 million.
Yeah.
And actually right now we're starting to see some market recovery, although some people think that this is another kind of a bubble thing because there's not a lot of inventory on the market, so a lot of people are bidding up the prices on homes. So do you think that that sort of approach of investing in real estate is a viable way of going now?
This valley has many wonder stories about investing in single-family homes, and you gave the classic example.
Yeah.
Bought it 50, 60, 70, and sold it 90, 2000, 2010, and got a multiple return out of it. We don't remember when real estate went down in value, except for the last 5 years.
Yeah, we did the last 5 years.
And because it was so serious.
Yes.
But there have been volatility of returns along the way. So public real estate is basically, get back to the original conversation about public versus private. Public real estate and real estate investment trusts owns hundreds of addresses. Private may only own 1 or 2 or 5 addresses in a partnership. So public is basically an index of what's going to go on in the marketplace, and you spoke about that. So over the past 10 or 30 or 50 years, the price of real estate has done this. And if you owned a REIT or mutual fund investing in real estate, you got a very similar return. In contrast to our clients who have been buying private real estate over that time frame, and over the past 20 years that we've been doing this, the average return approaches 20%. Because we're able to professionally manage this real estate. We buy, manage, and sell. We don't buy and hold. So we are equity investors, not income investors. And if I can get a 20% return by holding it for 3 to 5, by buying it, rehabbing it, and selling it, I think that's better than trying to buy it and hold it for 20 years and earn 5 or 6% appreciation.
So the idea is that with the professional management, and again, you could buy an underutilized piece of real estate, you can have some control over a return, especially over a shorter period of time. So this is a little bit different from your approach for the stock market, which is very long term. You've got more like a 5-year horizon for the real estate investments.
Good notice, yeah, really. And the difference between the publicly traded stock market and private real estate, for instance, is the publicly traded market is efficient. That means that all the information about every stock is known by everybody, openly, freely, widely. But the information about an address at the corner of First and Main in any town USA may only be known by the buyer and the seller.
Yeah. Craig, we're all out of time again. So thanks again for being my guest.
Thanks, Mike.
I think you shared some important information. Folks, I hope that you found this valuable, something to think about as far as alternatives for investment. We'll see you next time on Financial Insider Weekly.